Imagine this. You have just finished your year-end accounts. Your accountant tells you the good news that you made £100,000 in profit. You are celebrating, you feel successful. Then the next morning, you try to pay your staff and the payment bounces due to insufficient funds. How can you be profitable and broke at the same time? It sounds like a paradox, but it is the silent killer of small businesses. Profit is a theory, cash is a reality, and confusing the two is the number one reason healthy businesses suddenly die. In this video, I'm going to explain exactly why profit does not equal cash flow, the working capital trap that catches growing businesses, and most importantly, the 3 checks you need to make sure you never run out of money. My name is Feroz Khan, and let's dive into the numbers that actually matter. First, we need to understand what profit actually is. In accounting, profit is not money in the bank. It is a mathematical calculation. It is your revenue minus your expenses. But here is the trick. Accounting profit includes things that are not cash. Think about depreciation. You buy a machine for £10,000. You don't expense that £10,000 immediately. You spread it over 5 years. That reduces your profit on paper, but the cash left your bank account years ago. Or think about accrued expenses. You owe a supplier money, but you haven't paid them yet. That counts as an expense in your profit and loss statement, reducing your profit, but your cash balance hasn't moved a penny. So, profit is an accounting opinion. It measures performance over a period. It tells you if your business model works, but it does not tell you if you can pay the rent tomorrow. So, if profit isn't cash, what is cash flow? Cash flow is the cold, hard reality of money moving. The danger zone sits right in the middle, the working capital. Here is the trap. You make a sale, you send the invoice. In the eyes of taxman and your accountant, you have realized revenue. You have to pay tax on that profit immediately. But the customer, they have 30, 60, or sometimes 90 days to pay you. For those 90 days, you are in a dangerous limbo. You are paying tax on money you haven't received yet. You are booking profit that you cannot use to buy lunch. This gap is where businesses bleed out. Let me tell you a story about a client I see often. Let's call him John. John runs a marketing agency. In January, he lands a huge contract worth £100,000. He is ecstatic. He does the work immediately. He sends the invoice on January 31st. On February 1st, John looks at his accounts. He sees revenues £100,000, cost £60,000, and a profit of £40,000. He feels rich. He decides to upgrade his office and hire a new designer. He spends £20,000 on a deposit and equipment. Fast forward to March, the client still hasn't paid the £100,000. They are a large corporation. They pay on 90 days terms. But John's staff salaries are due. His rent is due. The tax bill is coming. John checks his bank. He has only £5,000 left. He needs a £30,000 to cover his obligations. On paper, John is profitable. Genius. In reality, John is insolvent. He grew too fast without checking his cash runway. This is the growth paradox. The faster you grow, the more cash you burn because you have to pay for resources before the customer pays you. So how do we fix this? As a director, you need to stop managing just the profit and loss and start managing the balance sheet. Here are 3 practical steps. First, cash flow forecasting. Stop looking at last month's profit. Look at next week's bank balance. You need a 13-week rolling cash flow forecast. If you know a gap is coming in week 6, you can fix it in week 2. Second, aggressive credit control. Your terms might be 30 days, but if clients pay in 60, you are financing their business for free. Chase your invoices early. offer discounts for early payment, cash in the hand is worth more than the profit on a spreadsheet. Third, inventory management. If you sell products, stock sitting on a shelf is cash trapped in concrete. High inventory levels look like assets, but they are a cash drain. Turn your stock over faster. To wrap this up, profit is what you report to the taxman. Cash is what you use to survive. A business can survive a few years without profit if it has cash, but a business can survive only a few weeks without cash, even if it is highly profitable. If you take one thing away from this video, check your bank balance before you check your profit margin. If you want clear, professional breakdowns of business finance and tax to help you run your business better, hit the like button and subscribe. I post new videos every week to help you understand the numbers that matter. See you in the next video.